Hello, everyone, and welcome to the Peregrine podcast. My name is Alex Gorokhov. I'm a director at Peregrine Communications. This is our series where we bring in leaders from across the asset management industry to discuss the newest trends, what they're seeing with their clients, and also hopefully learn a thing or two for ourselves. I'm absolutely delighted today to be joined by Margarida Ferreira, investor intelligence lead at Macfarlanes. We have actually known each other for about a year. And I was thinking to myself this morning as I was traveling in, if we had a year ago decided to do a podcast on private markets, how similar or different would the agenda look then as it does today? But very happy to have you. Would be lovely to have you introduce yourself to our audience today before we jump into some of the topics we're going to discuss.
Yes, of course. Maybe a lot of the listeners know Macfarlanes, maybe some don't. So good to give a little bit of an intro on the firm. We're a full-service law firm that's headquartered in London. And within private capital, we really do a range of services. So we work with asset managers, we'll work with family offices, with entrepreneurs, and a range of matters. Can be anything from structuring and tax to fundraising to deployment, all the way through litigation, and anything in between. But where I sit in the firm is a little bit different. It's a team called Investor Intelligence, as you mentioned, and this is actually a non-legal team. And that's because my background really is very much in strategy consulting, working with private equity sponsors on deals, doing type of commercial due diligence. So our investor intelligence practice inherits a lot of those traits. So it's very much a research function that we provide to our clients. And we research anything that can impact our clients' fundraising ability. So that could be trends in product development or how to reach institutional investors in different markets. So quite excited to be speaking today about these topics.
And I think actually when we providing intelligence to investors, but GPs as well, is something that there's no, I think in the industry that we work in, there's almost no playbook that you can follow because the industry changes so much. And if we go back to last year, but even the years before then, I think the developments that we've seen within private markets have been so rapid and continue to change almost month to month that I can imagine your conversations are so interesting, but also need to be active. I guess if we kick off with our first topic that I think you'd probably be able to guess what it might be if you've been following the private markets industry. It's the subject of private and public markets converging. And I think if we look at the evidence that we've seen of that happening, you can look towards KKR and Capital Group launching products together. You can look at Blackstone and their agreement with Vanguard and Wellington, or partnerships between State Street and Apollo. But I think what's really clear is that the private markets industry is evolving into one that doesn't quite feel as private as it once did. And that is both in terms of investor type, that's in terms of the reputation that it carries, and that can have positive and negatives. And we'll go into those a little bit more in a little bit more detail. But I guess my first question to you would be, what do you see in that space when you speak to your clients about that convergence of private and public markets?
Yes, that's a great question. I think that it's helpful to have a little bit of a framework around it when we think about this big topic of convergence, right? And the way that I tend to think about it at Macfarlanes, I think that's how we're aligned, is looking at the scale of deals being made, then the type of deals, and then the type of investors. So we definitely, on the point of scale, I think that this is no surprise that private debt managers, private equity managers have been raising bigger and bigger funds. I mean, one of the largest private debt funds ever raised 30 billion by Ares recently, for example. And we see so many more large transactions that would never have occurred. So even this year, with the funding rounds of OpenAI, for example, I think the last one, they raised 40 billion at a 300 billion valuation. That would just not have been possible in private markets 10 years ago. And they're not the only sort of growth company that has stayed private, right? So, of course, you can think of other big growth companies like SpaceX or What's the name of the TikTok owner? ByteDance, I
Yeah,
think.
yeah, yeah, yeah.
Something like anyway, again, companies that have raised tens of billions privately, so there's less of a need for them to go public. And so it's well commented on how, since the 90s, about 40 or 50% declined in the number of listed companies. Also, companies are just staying private longer. So that means that from a public market perspective, you can only access them on average when they are 11 years in
Wow,
versus
okay.
7 years in a decade ago. So that's quite a big shift. So that is the point on scale, right? That we're seeing bigger and bigger deals that a decade ago would only be done in public markets and that now are private. Then on the type of deals that we're seeing, I think this is quite an interesting one because there's always been this idea of public markets being on the safer side and private being on the riskier side. Now, of course, public markets also always have had risky elements, but at least would be safe and risky.
So yeah.
And private was very much, this is all risky, right? And everything was risky in private markets. And I think that's just, connected also with what we're talking about scale and good companies that choose to stay private and all these trends. It just means that you have a lot of really good quality assets that are staying private and want to stay private. And so bringing it actually, for example, with in the credit environment where things are actually assigned ratings, right? We're seeing so much more investment grade private credit. And that's something that, for example, Apollo and Nuveen and often very much asset managers that are associated with insurance firms, because that is a sweet spot for insurance. That's another interesting pillar of the convergence. And then I would say that the third pillar, which you alluded to, is the types of investors. So really going further and further down the wealth channel. So already in the past 5 years, we've seen a lot more happening in wealth, but often still quite restricted and quite a lot of financial requirements to be met. I mean, still a lot of the BDCs have financial requirements that mean that they are not suitable for the everyday investor. But we're seeing really the envelope being pushed further and further down. And as you mentioned, for example, with the State Street and Apollo ETF, right? An exchange traded product that includes public and private credit. That's something that's really quite interesting.
A couple of things to pick up on within that. I mean, at Peregrine, for example, we work with managers from all across the asset management spectrum, and I think one of the things that you said, which has made me wonder, when you talk about risk between private and public markets, I think there's also a thing that public markets. We're sat here in May 2025. Public markets are quite hard to explain a lot of the time today, and when it comes to political sway on certain sectors, how quickly things can change. As a traditional asset manager, investing in stocks and bonds, it's not that easy to explain or predict what's going to happen next. And there could be an argument to be made that the private markets industry, because it might be slightly more fundamentals based, because you might be investing in companies that aren't as volatile to, short-term fluctuations, that probably explains why there is so much more interest coming from that slightly more retail wealth. And we can get into the definitions of retail wealth and what that means. But I think that probably serves some role as to why people are turning towards, private equity, for example, and thinking, actually, maybe this isn't as risky as I've, been brought up to think. I've always thought this is this black box sector where it's, barbarians at the gate, and you can't, that's not something anyone normal in inverted commas can touch. But actually, maybe it's more normal than some of the market fluctuations that we see happening today in more traditional ones.
No, I think that's a really good point in terms of the volatility that you see in public markets is quite relevant, right? And even if they are liquid, but they will be liquid at what price?
Exactly.
And then the other element I think is often, as you hear a lot of managers speaking about the benefits of private capital, and obviously there's, as we talked about, there used to be a point of diversification, and now there's a point of diversification, but there's also a point of access because as we said, public markets are shrinking. But also there's this element of the concentration that you have in a lot of public markets index funds, right? So they're often can be quite volatile, quite concentrated. So as you say, I think that we're also questioning how safe are public markets compared to private, right? And again, going back to everything is a spectrum, and it's not as clear cut as public safe and private risky.
You mentioned towards the end the ETF from State Street and Apollo, and that leads me very nicely into the next subject area, which is actual fund structures and access to private markets. Because, of course, one of the great barriers to entry historically has been the fact that, unless you're an institution, to invest in private markets is incredibly difficult, whether that be the minimum investment that you need to make, the liquidity. And yet nowadays, I read this earlier that since 2019, according to PitchBook, there's been 200 evergreen vehicles launched. They now manage more than 400 billion, which blew my mind as a statistic. But I guess the question here is, how quickly are you seeing with your clients, but also in the wider industry, managers trying to rethink how they can structure their products to capture some of that new investor base?
Yes, I think that, if we go back to the three pillars that we talked about, so the first one being about scale and how do you create larger and larger funds, I think that that's sort of the one that impacts maybe structuring the least, but still has some impact in terms of having increasingly flexibility, being prepared and not having any friction when fundraising from different markets, being able to provide for large separate managed accounts. So increasingly we're seeing investors demanding a lot more flexibility, bespoke terms. So in order to have scale, you really need to work on that, on reducing any friction on the structuring side. Then in terms of that move towards the type of deals and the push for investment grade, I think that's quite an interesting one from a structuring perspective. And we're seeing actually an interesting convergence, particularly in private debt because of the income generating element of private debt and structured products. So we're seeing a lot more private debt CLOs or even collateralized fund obligations, and trying to really unlock some of, for example, in insurance capital, investment grade capital, which doesn't have to be just insurance. Actually, a lot of the wealth channels, often the products might have some elements of investment grade public and investment grade private credit, right? And then finally, wealth, which, if targeting sort of getting IG, investment grade quality private debt, is very much about structured products and structuring complexity. The wealth side, yes, you need different structures, you need semi-liquid structures, but it's much more about the operational complexity, I would say. Obviously, there's a lot in terms of managing different liquidity requirements, but there's a lot to be said about also fitting in nicely with distribution platforms. So it's quite complex on the operational side. And we of course see a lot of evergreen and semi-liquid products. And we at Macfarlanes, we tend to call evergreen things that are institutional and semi-liquid things that are for wealth. I think
That's a nice way of putting it.
There's a lot of different ways of addressing this, because we actually in Europe see a lot of evergreen structures for institutional investors as well. But they have a slightly different profile on liquidity and use of drawdown than what you'd see in a proper wealth product. So because that's actually can be one of the difficulties of structuring for wealth, is that often, an individual investor will and the distributors, the intermediaries, will not want a drawdown structure. That's quite difficult. So then that creates an issue for managers, where how do you create a product that is fully seasoned and ramped from day one? And that is quite difficult, particularly if you don't have a very large balance sheet. If you're talking about evergreen for institutional investors, they're very used to the drawdown model. So you'd expect an evergreen fund to be able to have that initial drawdown model and then, just be that perpetual capital over time. But that beginning, that initial part would actually be quite similar, although potentially at a slightly faster ramp up than a closed-ended fund. But then when you move to wealth, you're facing a different challenge there.
And do you think when you talk about balance sheets, do you think that then creates quite a clear barrier to entry for a manager to enter that space? I.e., do you need to be above a certain size to be able to pull this off?
Yes, absolutely. I think, and this is becoming quite clear that scale really does matter, and particularly in wealth, scale matters even more. And yes, having a large balance sheet is. There are other things that can be done, but it is a massive advantage for a manager that will be targeting wealth at scale.
It makes me think, actually, because we obviously spend so much time sitting with clients and trying to come up with their messaging and give them an angle that can penetrate the market in a manner which perhaps another firm can't. And I wonder whether there's something to be said for these managers who perhaps don't cross the threshold of AUM size or balance sheet size to be able to pull off the wealth angle. Is one of the things they need to be talking about, that actually they might stay more focused in comparison on delivering the kind of private markets investments that institutions have got used to. That's not to say it as a criticism of the larger managers, but managers throughout the history of time have always chased and looked for where the largest opportunity and pool of money is. And if you look at these huge managers now moving towards wealth, for the smaller managers who aren't going to go towards that, I think now probably is a really interesting time to start doubling down on what flexibility and opportunity do we keep by almost maintaining our pure play focus on institutions rather than trying to go into that wealth bracket. Because I think when we spoke about this when we had our meeting the other week, there's also a question of when funds will be investing on behalf of private wealth investors, different brackets. Is that going to influence the type of investments they're able to make? The traditional private markets lockup periods have been a certain way, and when you need to create something that's a little bit more liquid, that might need to hit more governance checklists, tick the right boxes. Does that mean that the smaller managers actually will in the long term gain from this because they will be able to truly prove themselves as being differentiated versus the larger managers who are entering a space of great opportunity, but also perhaps greater scrutiny and slightly more shackled in the way they operate?
Yes, I think there are a couple of points there. The first one, which I think is a great point, is yes, wealth is one of the avenues that is a clear future of private markets, but it's not the only way that a fund manager can go, and it's not the only way to remain successful as a fund manager. And so it could be that there's a fair assessment to say we don't think we'll be able to compete in wealth at scale. But then the other point of this is, what do we consider wealth, right? So because are we considering, you and me, or are we
probably not. Probably not me.
So, and there's so many levels of wealth, right? So there's pockets of wealth where definitely you don't even necessarily need evergreen or semi-liquid structures, right? So, and pockets of wealth that want the illiquidity and want to be closed-end. So, and want actually that institutional return, right? That the appeal is, I want to be investing in the same way that an institutional investor is able to deploy capital.
Yeah.
And that can be quite successful. But it's when we're talking about really scale, is when we're talking about wealth at scale and, doing some of the things that you talked about earlier, that, Blackstone or Apollo, State Street are doing. And that then you do have a barrier if you are small. and if you are not looking to enter the market quickly in the next 5 years, right? Because also from the perspective of intermediaries, I think there's good reason to believe that there will be a degree of incumbency and difficulty in replacing incumbents, because it, as we said, it requires a lot of scale. It is likely that intermediaries would prefer to have fewer relationships with managers that provide broader products rather than the other way around. And this will be because of the intermediary's own, operational constraints.
Time constraints.
They will have to do due diligence. They are also advising their clients, right? So then on that advisory side, it is difficult to advise on 1,000 funds. So I think that there's reason to believe that there will be a certain level of incumbency and a tendency towards consolidation rather than fragmentation in the intermediary market. So basically, yes, I do think that at scale is needed.
Yes, agreed.
But that does not mean that there are not elements of wealth, talking about family offices, high net worths, that you can't still target in a close-ended way.
I think that's exactly right. And it's one of the things we always advise our clients is try not to be everything to everyone, and that's marketing 101. So I think the larger managers, I think the challenge that they're going to have is they will continue to have a range of products. Some are more targeted towards a mixed pool of investors. Some will be purely for closed-ended. But I think trying to manage that messaging, even when it comes to things like educating your audiences, and as you really alluded to really well there, the idea of wealth as a singular entity is nonsensical, because you might be on one occasion trying to speak to an end investor who is investing in private markets for the first time, but you also might be speaking to an investment advisor who's been doing this for 2 decades, and therefore that you don't need to educate them on why private markets is the right choice. You need to educate them on why you are the right partner to enter the private markets.
But even with that, sometimes advisors that have been advising for a long time, they might still benefit from being, I guess it's almost helping them provide the advice, right? If you're an intermediary, if you're in that position of providing advice to clients, I think a lot of what is beneficial in the relationship with the manager they're engaging with would be help me help my clients with your product.
Well, it's a packaging job in some ways.
Exactly. And I think that, again, going back to scale or to the effort that it takes to be in this segment, is that you see that some of these managers are posting so much more content. Right? I don't know if this is something you've noticed as well.
Absolutely.
But I think, they're posting all the time. And it takes time also to create this content. And I think a lot of it is still very much directed at those distribution channels rather than the end investor. But still, it's a completely different perspective on brand, I think.
I think that one of the great branding challenges is if you look at the primary channels that investors / wider audiences may use to engage with the firm that they're interested in, it's still relatively centralized, which is it will be direct engagement, of course. It will be a website. It will be your LinkedIn channel, which perhaps you may have been referring to when it comes to content. But the challenge is that, say you are Blackstone and you have, I haven't looked at their recent numbers, but over 1 million followers on LinkedIn. Every post you do, you need to it's like giving a wedding speech. You need to cater to a lot of different audiences all at once.
Yeah.
And you need to capture and educate, perhaps a huge portion, or at least quickly growing portion of your audience who are interested in learning, what is private credit? How do you invest in infrastructure? What's the reason to invest in, growth companies when it comes to private equity? So you need to speak to them, but you also need to speak to people who have been investing with you for 20 years who actually might want significantly more detail on specific sectors and specific strategies. And what you see is the response to that often ends up being, exactly as you said, an information overload. So we need to speak to this investor in America, but we also need to speak to this intermediary in the Nordics, and therefore we need to make sure we're getting out 3 posts a day to tick everyone off. But the reality is that if you do that, your message ends up getting quite saturated because you're saying too many things to too many people all at once. And so the best managers, and actually Blackstone, we can stay on them, is they realized that they needed a core message to kind of pull all of this together, and they went with this build with Blackstone tagline. And the cool thing about that is that it's something that appears in every bit of content they do, whether it be build your career with Blackstone, which is targeted at talent who they might want to hire, build wealth with Blackstone, targeted at obviously the more retail audience, but build infrastructure with Blackstone. They are tying everything in together. So at the very least, even though they do have these pressures to put out a lot of content and speak to a lot of people at any given moment, it feels connected to each other. And I think that's so important in an era when we open our phones, we go on our computers, and it's just information, information, information. You need to make sure that what you're telling to the market, even if you're speaking to different people, it still feels nicely joined up and it feels like your own proprietary content rather than just almost in a reactionary manner saying what people want you to say.
I do like this the trend of taglines in private markets, because there are a few cool ones as well. I don't know if you saw the Apollo. Was it Apollo? I think so. The Christmas one. That was the no new toys.
Oh, that's
and
it.
it was
Yeah,
this
yeah, yeah, yeah.
entire
It's a very good
video.
one.
And that was actually, I don't know, I like that as we see more of this awareness of branding, you start seeing more interesting taglines as well.
Well, it's because finishing up on the private and public side of things, it's the reality is because we've seen this with hedge funds post the global financial crisis where they were under so much scrutiny, but also got so into the limelight that they also decided to go slightly more front-footed with marketing. These big private markets brands, they need to brand themselves like from almost, I wouldn't go as far as saying exactly like it, but they're moving more towards B2C in their style of communications because people will start to invest in firms also because of the brand, not just, as it was perhaps some years ago when it would be a due diligence process looking at kind of the returns profile, et cetera, et cetera. Nowadays, a lot of people will be going towards these brands because they like what they stand for. Perhaps there'll be an angle of values. So, I agree with the values of how this firm invests. I'm going to go with them and I'll wear it as a badge of honor that I am a Blackstone investor or an Ardian investor or a KKR investor. It almost feels like I don't want to move to the subject, but with any area as prominent as private and public markets, we need to also speak about the risks that may exist there. And Orlando Bravo, obviously, very famous co-founder of the buyout firm Thoma Bravo, I think he came out in the FT the other day in a story saying that he thinks that the growing pool of private funds aimed at individuals could leave those investors saving companies that private equity groups simply cannot sell. He actually went on to say that retail investors might not be as sophisticated. There might be the risk of them not understanding what they're involved in, and then this could create all sorts of problems. How much do you see that as an acute risk today? How much have you discussed that with clients? What are their thoughts on ensuring that this new pool of money is educated enough in how the private markets work?
And I think that a lot of the GPs that are in this space are quite aware of the potential reputational risk that the space can have, right? I think that there's also a broader conversation to be had about, as private markets converge with public markets, we talked about the wonderful things that brings, but also it brings so much more scrutiny, the scrutiny that you have in public markets, right? Which is actually what we try to avoid, or companies try to avoid by being private, and why we like private markets. But then as the asset classes grow, they are just attracting a lot more attention from regulators, and that will continue to be the case because of articles like that, and because ultimately there is a fair point that individual investors in particular have to be protected and have to understand what they are buying into. But that's not to say that there aren't ways of of doing it, right? And I think that, I know, as we mentioned, it's not like most products in private markets are now being sold to us.
Yes, yeah.
They're mostly being sold to intermediaries where they're receiving advice. And again, they're receiving quite a lot of education. And I don't think that there is a lack of resource available. As I said, I think a lot of managers are putting a lot of effort into content creation and into education. But of course, that's sometimes just not enough. And there will be situations where people will enter products and situations that they didn't fully understand. So I think we should be alert to that. But that doesn't mean that we should say, okay, then we have to completely exclude individual investors from this and that there's no way forward to include them. Because, going back to some of our original points about public market shrinking and it being almost a point of access, why can't they access these companies, right? And I think we'll speak a little bit about pensions, but I think that one of the really interesting things is when you talk about wealth and pensions together, right? Because there's some overlap in the fact that we're moving more and more to a system where people are responsible for their own retirement outcomes. That did not used to be the case. You used to have defined benefit pensions where your retirement outcomes were guaranteed for you. Okay. Now the risk is on you.
Yeah.
So, and then we're saying to people, okay, but you actually cannot. So you have this long-term liability that is yours to manage. It's your long-term liability, but you are not allowed to partake in long-term illiquid assets. So, which is actually something that pension funds are able to do, right? So you have a situation where if you are in a public, still defined benefit pension plan, so you're a social worker or you're a street sweeper, you actually have a decent chunk of your retirement portfolio in private assets. But if you're part of the defined contribution scheme of a private company, and so you have your own retirement risk, you cannot invest, or you're very, very limited in your investments in private markets. So you're not being given the opportunity to match your long-term liabilities to long-term assets, which I think is quite interesting as a dynamic. So I think that also thinking about this element of, it's obviously, again, it's a type of intermediated wealth because we're not often talking about, self-invested pension plans. We're talking about still things that are intermediated through the fiduciary duties of a DC scheme. But I think that there's that broader sort of macro theme of if we are going to be in charge of our own retirement, then why can't we invest in illiquid assets?
So carrying on the theme of pensions and this, when we speak about private markets and investor types, pension plans have been investing in private markets for a long time, but perhaps the way in which they invest and the scrutiny under which they are investing has evolved significantly. I think it's no secret to anyone in the industry that we work in that most public pension schemes and indeed sovereign wealth funds intend and have indeed increased their allocation to the private markets overall. That said, the increases and perhaps the general trend that we're seeing in the alternative asset management industry is that we're seeing more articles, featuring quotes from various financial watchdogs talking about the risks associated with investment in private markets. I saw a story the other day, which was that the main Canadian pension plans, so CPPIB, Ontario, etc., their performance was dragged down primarily by poor private equity performance in the portfolio. That obviously doesn't do any good to the reputation of the sector. So you've got these sort of opposing forces going on at all times. What are you hearing in terms of, let's say, the push that is happening from governments to get pension funds invested in private markets? How true is that? And what are the reasons behind it?
I'm actually quite happy to be talking about this topic because I often look at institutional investors across the world, and I quite like actually thinking about what's happening in the UK. Um, and in the UK, it's a very interesting time for pensions, and one where, things normally in pensions, it's not the industry that's known for moving the fastest. But in the last 3 years, there's been a lot of movement, and there's been a big push by government to get pension funds to invest more in private assets. And the focus really has been twofold. So one being about retirement outcomes, which you make a good point about. The article that you read about the Canadian pension
Yeah.
plan and private equity and how that's maybe not been so favorable in the last year or two. But also you could read so many other reports about the Australian retirement system and actually even Canada. Canada has been broadly successful. Canadian pension plans have been broadly successful in their allocation to alternatives. And I think that actually, if you don't look at it as just 1 year, which is actually not how we should be looking at pension outcomes,
Hopefully not, no.
over time, I think that broadly it is still quite accepted that private markets have had a positive impact in returns over time. And so we want to be able to have that for UK pensions as well. And the other big point is the point of the government really trying to channel private capital into the country and to fuel economic growth. So actually there's sort of three pillars and themes that when you talk about UK pensions, I think are relevant, which is the pushing for scale, which is really important. Both, the Canadian model has a lot of scale, and Australia as well.
Which we saw the first move towards through Rachel Reeves's pension pooling plan announced last year.
Yes,
if that's correct.
That is correct. So that was interesting because the concept of pooling in the LGPS, so the local government pension schemes, into different pools, I think it's 8 pools in England and Wales, that was already going on. That wasn't necessarily new from last year, but there was, I guess, it was reiterated that was very important and that it should be done faster. So there's a renewed interest in consolidation, but it should be said that this is a trend that has happened for a little while in the UK. And in fact, you do already have these pools, and they already have a lot. They already pool a lot of the assets of the individual LGPSs. And then the other point that we're talking about investing in the UK, that is again a little bit contentious because obviously it's difficult sometimes, the interaction between that and fiduciary duties, and will ultimately pension plans and our pensions should be invested to maximize our investment outcomes for retirement. So why should we be restricted in investing in the UK if potentially the UK is not the best place to be invested, right? And so it raises a lot of questions about
fiduciary
duties in a not so different way as ESG, actually. Through a certain lens.
It's a different angle on the profit versus purpose
discussion.
I mean, the UK is such a fascinating example of that because, you can look at high-profile companies which have had issues. Thames Water is the one that always springs to mind. But, you have pension funds from abroad investing in UK assets, and I don't have the numbers to hand, but probably more, but certainly on a comparable level to UK investment in companies here. And I don't know. I think when it comes to, it's one of the things which often comes back down to education, which is, I think so many people who have their money with pension plans don't really follow where the money goes. I think you have vocal activists who really scrutinize and they look at it. And I know we keep mentioning Canada, but it's just such an interesting example of that pension plan. I worked for one of the major ones a few years ago, and the scrutiny that the Canadian press would put on them, for certain types of investments was really prominent. Whereas the reality is that the majority of those invested in a pension plan simply will look at the number of how their pension is doing, and therefore that mix between looking for a longer term healthier return versus perhaps shorter term concerns or wants when it comes to the type of investment you want to do. I don't know how active your average pension plan investor is in looking at that kind of fiduciary side of things.
Yes, no, that's a good point. And there are two things there that immediately come to mind. First is in the UK and in the defined contribution space, where you can engage with your pension provider and say that you want to make changes, you want to leave the default fund. Over 90% of people stay in the default fund. So not loads of engagement. But the other point, and why I think that there should be an effort to have more engagement in the UK, is because the Canadian model is still very much based in, particularly when we talk about Canadian pension plans, we're often talking about very large defined benefit pension plans. So back to what we were saying before, defined benefit pension plans, your retirement income is basically guaranteed. Right. So even if there is tremendous overperformance, in most cases, you will not benefit from that overperformance. And if there is underperformance, often there are government programs and things that are done to save people's pensions. In the UK, you have a lot of capital that has moved to defined contribution plans, and that's only growing, right? So I think right now it's about 500 billion that is across trust-based defined contribution and contract-based defined contribution. We can talk a little bit of what those are, but regardless, so defined contribution as a whole is about 500 billion, and that is expected to grow to 800 to a trillion in the next 5 years, right? So that's quite significant, and that compares with, private defined benefit schemes. They're about 1.2 trillion, but on a declining route. But bringing back to why this means that you should have more engagement is because on the defined contribution side, as you said, you will be responsible or will be impacted directly by your investment decisions. You have the investment risk. So if it overperforms, brilliant, you have an amazing retirement. If it underperforms, you might outlive your money.
Yeah.
Which is a scary thing, right? So really, the levels of engagement that you have in the UK, I personally think that they should be a lot higher. And I think that, for example, you have more engagement in the Australian model. Australian model is more defined contribution, so in that way more comparable in that angle. And more focus on the returns that you're getting, right? Because right now in the UK, the focus has been very much on cost, and it's the employer that chooses, and they tend to choose very much based on cost. So this needs to be an education. Often, when you talk about the value for money frameworks and how the government is really trying to focus more on value and net returns rather than just cost. That can't just be for the pension fund trustees. That has to be for the DC trustees, but that also has to be for the employers that are making these decisions, and that the employees that should be demanding better investment outcomes.
Do you think that's something? I mean, if we look at this space as a whole, what do you see going forward? Do you feel like that level of engagement? I know you're suggesting that you think that's what should happen, but sometimes the things that we think should happen don't always materialize. Do you think that level of engagement is on the horizon, and what other things should we be looking out for when it comes to this pension subject area?
I think the engagement on that DC trustee level is considerably changing. I think that the further down you go, I'm not sure we'll see massive engagement still by your everyday person. As much as, because I spend a lot of time on pensions and the opportunities that I bring to private capital and speaking to private capital managers about how to make the most of this. I think I'm incredibly partial that I think I spend a lot of time thinking about pensions, but I don't think that will quickly become the norm
Yeah.
for many other people. But I think that's even more so why they need to be protected in a way and to be given good investment outcomes, because they will not be thinking about it, but they will suffer whatever the consequence it is of that, right? And so again, go back to this point of, should they be now investing in private markets? And do you think that's right? And why would it be that they can't, Particularly because, as we said, 90% of them are in the default funds. So they are not managing
I didn't
it
realize the number was
themselves.
that big.
It's huge. And what that means is that, they are not managing it themselves. So you can't even say, oh, it's these individual investors, they know nothing about private markets. We can't allow them to be invested. It's often they have that layer of protection of being in the default fund that is invested by professional investors. And again, this then links to a broader structural thing in the UK of how the different barriers that there are to go into private markets, which briefly, but are very linked to insurance platforms, the regulations that we have around insurance platforms that limit the type of products and of access that we can have to private markets, which is, very much a topic that we speak all the time to our clients about.
When you think about those conversations with clients, we've obviously covered quite a lot of areas here, but what are the main things that you think managers should know when it comes to addressing the pensions market?
Yeah, so I think that the first thing is really to have a clear map of what is the pensions market in the UK, because it's about 4 trillion in assets, but they really are divided in different ways. Of course, everyone knows the difference, but most people know the difference of defined benefit, defined contribution, but understanding then how, you have public and private defined benefit. What's happening to the private defined benefit that is going extinct? Where is that capital going? That capital is going to super funds or going to insurance companies. And the DC market has got the trust base and the contract base. What's the difference? For example, one of the key differences is that a lot of the things that have been agreed and a lot of the commitments of Mansion House Compact, even things on performance fees. So, for example, the performance fee being taken out of the charge cap, that all has only happened in trust. That has not yet happened in contract because it's regulated differently. Because one is the pensions regulator, the other one is the FCA. It is expected that the FCA will follow, but you see how suddenly we're having this conversation about DC schemes in the UK, and we're maybe not even in this conversation acknowledging that there are differences, right? So I think that having that really clear map of what are different pockets and how capital is moving as the pension industry is changing, and as we're going through this secular move where we're moving from someone else guaranteeing our retirement income to us being responsible for it. So I'd say that's the really key thing. And then just on top of that, and they're saying, okay, for each of these, what are the things I need to think about to access these pools of capital? Where do I need different structures? Where will I face more cost pressure? Those types of things.
I think if there's one recurring theme across our entire conversation, and it's something I learn more and more every year working in this industry, is that you have these big words like pensions or private wealth or private markets, but actually it's like a Russian doll. There's always a different level to it, and there's always a different layer to it. And I think the pensions industry in particular, from what you're saying, it really strikes me that you can't treat that entire pension funds pool globally as singular. You can't treat even a national pensions pool as singular. These things break into so many subcategories, different structures, different types of investor, different levels of engagement. I mean, as you said, only 90% or rather 90%, only 10% actually actively engage and move from the default fund. It's interesting to see how much education there will be going forward from not even necessarily pension funds themselves, but actually from authorities who, people are going to be living longer from a demographic perspective. The cost of living still remains, a significant issue in the UK as it is. How much pressure there will be to teach people about their pensions and say, this is the kind of return you should be expecting. This is what would happen if you switched over to a different provider or a different type of scheme. I think the question that remains on my mind is who's going to take responsibility there? And I think there could be a really strong case that it actually shouldn't be anyone related to any particular fund or firm. It should actually be an independent body which really goes on the front foot and educates people, because I think everyone could use more information, particularly the average person in that 90%.
Yes, and you've seen industry bodies, and for example, the BVCA has done a lot of great work on this topic with bringing together managers and um, pension trustees, for example.
That leads us really nicely into our final topic of conversation, which is investor intelligence. And obviously, that's something that sits in your title, in your team. And I'm sure that two words doesn't do it justice in terms of the breadth of what we mean when we say investor intelligence. But the reason I wanted to discuss it with you today is investor intelligence is something that we look at a lot as a marketing and communications agency, because when you represent firms of different strategies, different geographies, different sizes, ultimately what you're trying to do is provide information or intelligence to investors, potential talent recruits about what makes your firm special. And I assume when you're an investor, that's what you're doing. You're looking towards the market, you're gathering intelligence and information, and then looking to make an educated decision based on that of what strategy you want to invest in, who you want to invest with, and how much you want to invest. But yet we live in an era of information, overabundance. There is more and more research coming out the entire time. There is an increasing role to be played for AI, automated decision making platforms. And so I guess the question I wanted to ask you is, when you think about investor intelligence in a philosophical manner, how much do you think it's a combination of the human side of sentiment analysis, getting to know LPs, GPs, understanding how they think, versus how much do you think the research data side of things is taking over? How do those two things coexist?
I mean, maybe not the most interesting answer, but I think that they are both relevant. I don't think that the industry lends itself to only desktop research, right? Because, I mean, if you think about private markets, right, by definition, they are quite private. There is a lot of information asymmetry. It is that information asymmetry that also, that inefficiency that creates returns, right? And that means that a lot of things are not publicly disclosed. And that's not really changed. I think that there's a role of AI, but often the role of AI, for example, if now you were to try and really figure out private markets just using ChatGPT, you will not get that far because of the lack of public information. Surely it will be helpful in many ways. But actually, I think AI is more interesting than as a tool, being for GPs, for LPs, where they can use for their own internal data sets. But actually, in terms of public data sets, it's a little bit limited. And one of the interesting things actually in that has been that you've seen this, that BlackRock, they acquired Preqin, right?
Yes, yeah,
and that's
yeah.
going to be integrated in the Aladdin platform.
Yes, yeah.
So that's quite interesting. And okay, then we go back to public-private convergence in an investment platform. But even that, and Preqin is a brilliant platform and it's very useful, but it's still not enough. And there's still a lack of information, and there's still a lot of things that you'll only know by speaking to people. And I think that on an LP front, that relationship aspect has not gone away.
Yeah.
And even after COVID, it has not gone away. And I was actually, as I was thinking about this the other day, thinking about even the fact that, most funds will have key person provisions, where we'll literally say, if these people aren't around, to an extreme, this could lead to the fund having to wind down. So it's an industry where we're still saying that people are indispensable. And so I think that connects quite nicely with also what I do and how much value you can have by just being in the market and speaking to people and seeing things and hearing things from a different lens, and a lens that's just not publicly available.
The way I try, and I completely agree, the way I often try to think about it is you can quantify the past, but it's not very easy to quantify, or perhaps you could even say it's impossible to quantify the future. And so what I mean by that is data can be used really neatly and very efficiently to explain past trends. And as you said, your Prequins or your PitchBooks, all these data platforms in the private markets industry are incredibly helpful because you can really see how allocations have trended over time and what portfolio makeups have looked like. But I think, as you correctly put there, when you are trying to understand what a GP's plans are for the coming years, what they're thinking but haven't decided yet, kind of that real softer human side of sentiment. People often talk about market sentiment, but I think that decision making or process towards decision making, I don't think it's something you can quantify. I think it's something you have to feel, and you have to speak with people. And depending on when this podcast is released, we will likely have just got back from Super Return,
Yes.
which, you just have to look at the numbers of people traveling to Berlin from all over the world to speak with each other, not to sit through decks and be presented, data points. Of course, those are important as supplementary evidence to a case you might be making to an LP. But ultimately, people go to sit like you and I are here, to understand each other face to face, because I think in the private markets, more so than anywhere else, there is a lot of information that sits within the CEO of the portfolio company that they're invested in, or the head of strategy at the GP, or the head of allocation at the LP. That's simply not in any public resource to be found that could then be turned into quantifiable data. That's something that comes through in conversation. And I think you really value that at your role in Macfarlanes. To even find some time for us to sit down is always difficult because you're always traveling and speaking to people. But I think that will always remain important.
Absolutely. And even, on the point of, yes, that with certain LPs, Prequin, PitchBook, with Intelligence, many other providers will have quite a lot of data. So particularly US pension funds, they publish a lot of data. So they often will publish the minutes of their investment committees and their board meetings. And, if you're patient enough to go through all of them, you can have a lot of information. I mean, we do that as well. But actually, if now you consider, other investors, even European pension funds, you're talking about a completely different level of information. And then if you want to talk about Asian investors or in the Middle East, you can find very, very little, even with these subscription partners where, you're paying a lot of money for them, but ultimately, they can't deliver what they just don't have, right? And it's really can be quite opaque, particularly if you are talking about, as I said, either geographically less transparent countries, or depending on the type of investor as well. Because linking back to our conversation of not just going to, traditional institutional investors, very large institutional investors, pension funds, insurance companies. But if you go a little bit, into family offices are very hard to get data on, highly idiosyncratic as well. And then going even further down to sort of high net worth, then, you can see how very quickly you have no way of getting information about these types of investors at this level of specific mandates and what they're looking at, right? Some platforms will have more than others, obviously, and that will also be the differentiating thing that they'll say about themselves, that they focus more on this or more on that. But truthfully, it's hard, and also it's not aggregated, so you'd have to have so many different subscriptions.
And to, I guess, add to that point, it's not in their interest to release that information. They don't want, a family office doesn't want their entire mandate or their kind
Yes.
of their strategy out in the open. They will probably benefit from keeping some of those things quiet. So I think we're completely aligned. It's never going to be 100% one way or 100% the other. It's about finding that balance between the two, and combining it to your advantage. I guess wrapping up, almost, when you think about how investors make decisions today, how do you think that might look tomorrow? What's the likely trajectory of the investment process?
I'm not sure it will change that much. I think that how we think about portfolio construction might be changing a little bit. Again, what we're talking about, private and public markets, I think that's changing a little bit in how we look at portfolio construction. But I think also that there'll be a little bit more on wanting things to be bespoke, wanting flexibility. But again, that's a trend that we're already seeing, but I just expect it to become more prevalent. And then also on the point of portfolio construction, I mean, it's not one of the topics that we covered much today, but I think because private credit and private equity markets are actually now having quite, well, in private credit less so, but more active secondary markets.
Yes.
That is also an interesting tool in the playbook. I think that they'll just have more tools, In a way, it adds complexity, which I often think about for LPs. It's becoming more difficult because there are all of these different decisions that you have to make. And because also it's a good thing because you want flexibility and you want managers to adapt to your needs. But at the same time, it makes decisions harder. And even, for example, on fees, right? We've seen a lot of push on fees. And we've seen a lot of, for example, the credit space has been more pushed on fees than the equity space. And so now we see a proliferation of terms. So rather than, for example, in an equity environment where you look at managers and you say, everyone is 220, okay, but
Yes.
who's the best one?
Yeah.
You now have situations, particularly in credit, where there's so much variation, and now you have to do your own modeling and your own assumptions of how the funds might go and how the market might go and what that means for you in terms of your fee position, and would you have been better off with a lower performance fee and a higher management fee, or the opposite? So I think there'll be more complexity for LPs, but also in a way, that'll be a good thing because there'll be more bespoke solutions, and there'll just be more tools.
Well, as we said, I think the other week, markets always need to be a bit imperfect because
Yes.
if they're imperfect, then that means there's opportunity. Final question, if that's okay, for the day,
Yes.
which is, if you could give one piece of advice to a GP trying to stand out in today's markets, what would it be?
You actually mentioned it already, and I'm gonna echo that, which is to really hone in on what they are doing that is differentiated. And it could be because of the strategy, it could be because of the market. There are many ways. It could be because of their level of servicing. But what is their differentiating factor? And will that hold in 5, 10 years' time with the evolution of how private markets are going? And then on the structuring product side is don't have any friction. So focus on what you do really well and then remove any friction on the product side. Because as I said, investors are often requesting different things. Like you might need to offer different currency sleeves and co-investment and large separate managed accounts and maybe some flexibility on how you think about fees. It's a very competitive fundraising environment. It will probably not get any easier. A lot of large institutional investors are quite allocated to private markets, and you know we're getting into a much more mature stage of private markets, still with a lot of room for growth, but competition is not going to get easier. And so to focus on your unique set of skills and then to not let structuring and product be the thing that gives an investor an opportunity to say no to you. Don't let them say no because of that. So remove that friction is what I would say.
Very good advice. Well, Margarida, thank you very much for the conversation today. Found it super interesting. Hope people listening in have also found it interesting. It feels like we could record 5 more podcasts right now, but we'll leave it there. And thank you very much and look forward to seeing you soon.
Thank you very much for having me. I thought the discussion was really interesting. And I appreciate any moment to talk about these topics, and particularly UK pensions, a favorite of mine always. So thank you so much.
Indeed. And we'll leave a link to various pieces of research from the Macfarlanes team on the subjects that we discussed today in the links below.
Thank you.
Thank you very much for listening. For more of our Peregrine content, please head over to our website, our LinkedIn, or our Spotify, and look forward to seeing you soon.